Leggett Platt, stock ticker LEG, is currently trading at $29.66. Year to date, they are down 9.1%, and over the last year, they are down 14.25%. They have a very strong dividend history of 29 years of consecutive dividend payments, and also recently they have raised their dividend by 4.5% to 46 cents. The company's commitment to dividends is strong, but its payout ratio on net earnings and free cash flow has been increasing, approaching critical levels, as we can see here on Simply Safe Dividends, where we do have 111% for the next 12 months on earnings payout and 71% on free cash flow payout for the next 12 months. But Simply Safe Dividends are also giving Leggett Platt a safe rating on their dividends, so it should be safe for the foreseeable future. But in this video, I want to take a closer look at the intrinsic value of Leggett Platt. So let's jump into a stock screener, punch in LEG and wait for everything to auto-populate. Here we see that the PE non-GAAP forward ratio is 16.4, which is roughly in line with the 5-year average, slightly a bit higher. The dividend yield is 6.2%, and as we saw earlier, the dividend ratio is pretty high. The short interest is also 4.3%, so that is something you should notice a little bit. The 52-week low, is around the current level, and the 52-week high is $41.94. The analysts have a target price of $30, which is roughly in line with the current price, and the target growth of around 5%. They do have a negative EPS growth of -2%, and the return on equity is at 16.8%. But let's jump into our dividend data tab and zoom in a bit so we can see everything a little bit better. And what I want to see here is take a look at the first table up here and to see a nice steady growth. So as you can see here, the last couple of years, it has been growing with around these 2.5 upwards to 5 and 3.8%. So it gives a growth rate over the last 10 years of 7.3%. This is boosted a little bit by some of the early ones, like for example, this one at 37%. So most likely the dividend growth rate for the foreseeable future is closer to these 4 or 5% maybe rather than 7. And also, if we come down here to the dividend yield theory graphs, we can see here on the right that we do have the 5-year dividend yield. Whenever the graph goes above the line into the blue area, that could indicate a potential undervalue of Leggett Platt, and whenever it goes below the line, turns into red, it could potentially be overvalued. But as we can see here on the graph on the left over dividend yield, according to the dividend yield theory, there is a 29% discount at the current level. I do, however, want to look at this graph with the cumulative rate of return, the time rate of return, that says that, for example, if you did have S&P 500, which is the red line, and we have the green line, which is Leggett Platt, you would roughly be the same place if you had invested in Leggett Platt solely compared to the S&P 500 over the last 10 years. So you would have only the dividends, almost no capital appreciation. But to find out the intrinsic value, we do have some models we can put a look into. The first one being the discounted cash flow model, where we do take the free cash flow from the different years. We then put them into this graph here, into this table, and apply a growth rate. I have chosen 5% since that is what the analyst thinks going forward, even though the average growth rate is much higher. We then use this growth rate to project the future free cash flows. We can then use the discount rate of 9% in my case to discount them back to a present value of these future free cash flows. We can then use their cash equivalents and the total debt along with the shares outstanding to arrive at a fair value of $30.63. Next one is the dividend discount model, where we do take the dividend payout from the different years. We then calculate a growth rate and an applied growth rate. I have used 4.5% since that is roughly the average going forward, I believe. The weighted average cost of capital included is 7.3. Combining all this together, we arrive at an intrinsic value of $68.76. Next one is the multiples valuation. We do take some companies that are peers to Leggett Platt and uses their EPS and multiples to calculate a median PE. We then use this median PE with the EPS from Leggett Platt to arrive at a stock price of $27.53. Next one is the price to earnings valuation, where we do take the PE ratio from the different years. We then average just the last 5 years together, combine that with the last 12 months of EPS. We arrive then at an intrinsic value of $31.42. Next one up is the Graham's revised valuation, where we take the EPS of Leggett Platt alongside a PE North Growth company, the growth rate going forward from Leggett Platt, a average yield of AAA corporate bonds, and the current rate of yield of AAA corporate bonds. All this put together using the formula here on the left, we arrive at an intrinsic value of almost $23. The next one is the free cash flow valuation, where we do take the price to free cash flow ratio. We then average the last 5 years together. We then take the free cash flow per share, and then we calculate based on those numbers the intrinsic value to be $31.36. Last model is the Peter Lynch model, where we do have the growth rate, the dividend yield, and the PE ratio of Leggett Platt. Combining all these together using Peter Lynch's formula, the intrinsic value is calculated to be $20.58. Before I jump into the summary, thank you so much for watching. If you haven't done so already, please consider subscribing to the channel and liking the video. And let's jump into the summary, where we do have all our valuation method that sums together for an average intrinsic of $32.83. With the current price being $29.66, that could be roughly 10% undervalue right now, at least according to the average intrinsic value. I would definitely put in a margin of safety at, let's say, 15%, which drops the acceptable buy price to $27.91. Leggett Platt may struggle to grow the revenues and margins fast enough to outpace the obligations they have right now, and that could potentially put the dividend at risk of being cut in the future. I would definitely, if you are into Leggett Platt and do believe in the company's long-term outlook, I would definitely wait for a little bit more of a dip before I would buy in. I think at the current levels, it's a hold if you already have it. But if you're looking to buy into the company, I would definitely wait a little bit, maybe 10% dip further, then it would be probably an acceptable buy price in, because it do offers a really juicy dividend, but there isn't that much room for capital appreciation, I believe, as we also saw with the analyst target price of being roughly the equal of what it's worth today. Thank you so much for watching. I'll be seeing you in the next video.